Hello everyone. Just want to welcome you to today's webinar. I am Eric Cardinal. I'm the Vice President of the M&A Club, and we are proud to co-sponsor the webinar today with our presenters from Sapling Financial. Before I give them the opportunity to speak, just a few words about the M&A Club. We are an M&A mergers and acquisition professional networking club. We've been around since 2009. We are now a pan-Canadian organization. We have chapters in 16 cities across Canada, from Vancouver to soon to open the city of Halifax. So we have members all over Canada. Total membership is about 3,000. And once again, very specific to the mergers and acquisition market. Only M&A professionals are part of our networking club. We are also planning an international expansion of the club. We are, for the first time, opening clubs internationally. Our first locations will be Hong Kong and Dubai, which we are planning to open in the fall or early 2026, while I am in Hong Kong for an Asian Financial Forum conference. So without further ado, I just want to once again thank Sapling and welcome Stefan and Dave to our webinar today. Gentlemen?
Yeah, thank you, Eric. Hello everyone, and thanks for joining us today. As Eric mentioned, my name is Dave O'Brien. I'm joined by my colleague Stefan Mioc, and today we're going to be talking about the internal and external factors that impact valuation multiples and how business owners can best manage for value. So here we just have our agenda slide. We'll start with a brief overview about Sapling. Then we'll get into an understanding of what a valuation multiple is. And then we'll dive into the internal and the external factors, respectively, that drive multiples before opening it up to some Q&A. So should mention, if you have any questions, you can put them in the Q&A chat, and then we'll get to them towards the end of the session today. But first, just a little bit about Sapling. We are a boutique financial consulting firm specializing in financial modeling, data analytics, and due diligence services geared towards the middle market. This slide here shares a little bit more detail about each of our services under each of our core service lines. And we'll circulate this deck after the session. I don't want to go through all this content today, but if you are interested, it'll be in the deck that we share afterwards, and you can take a look sort of at your leisure. Next, just a little bit about the two of us. So as I mentioned, I'm Dave O'Brien. I am a CPA. I have a master's in finance, and I'm a senior engagement manager with Sapling, specifically specializing in our financial modeling and due diligence projects. Stefan?
Hi, everyone. My name is Stefan. I'm a senior engagement manager at Sapling with a focus on financial modeling and valuations. Prior to Sapling, I was at Grant Thornton for just over 5.5 years, 5 years-ish, in the M&A group. Next slide. So I think we just wanted to kick things off with just a quick polling question, just to get an understanding of everyone's backgrounds on the call today. Maybe take 10, 20 seconds there. I don't know if we can see the results. Okay, there we go.
Oh, there we go.
So pretty even spread in the bottom three, mostly professional services as expected. So that's good to know as we work through the presentation. So yeah, first, just wanted to dive into really understanding valuation multiples to begin with. Go to the next slide there, Dave. Thank you. So yeah, a valuation multiple is typically applied to some sort of financial metric, such as EBITDA, shown below, to really just assess the value of a company. And all a cash flow multiple really is a measure of risk. And the higher the risk of a company, the higher the required rate of return, and therefore typically the lower the multiple. And a cash flow multiple such as EBITDA or EBIT can be thought of just the inverse of the discount rate or required rate of return. So if you have an investor, for example, requires a 20% rate of return, if you take 1 over 20%, that gets to your 5 times multiple. Now, let's say the risk of a company increases, which means the discount rate will increase or we'll have a higher rate of return. So if we take, for example, 1 over 25%, our multiple will drop to 4 times for the increased risk. So typically, common cash flow multiples you see in practice are a multiple of normalized EBITDA. This is typically utilized by buyers when submitting an LOI to get to a purchase price. A little less uncommon is just the multiple of normalized EBIT. In valuations, this is typically used for more capital-intensive businesses. In terms of a multiple of revenue, this is another multiple others may have seen in practice, but this is more so for companies that may be early stage, may have negative earnings, or sometimes for tech businesses where it's a multiple of annual reoccurring revenue, for example. And then another one people probably recognize is your PE multiples. This is more so used in security analysis. So like I said, typically multiples usually apply to normalized EBITDA to reach your enterprise value or your purchase price, and it's shown by the formula there at the bottom. So this slide just speaks how we get to normalized EBITDA and what it really is. So to get to EBITDA, you typically take your net income and you add back your interest, taxes, depreciation, amortization. And then to get to normalized EBITDA, we make some further adjustments that just removes the impact of revenues or expenses that a buyer may not perceive to take on after they purchase the business. So common adjustments you may see are related to discretionary expenditures. So this can be personal expenses that may be put through the company, such as personal vehicles, personal phone bills, maybe personal like home improvement expenses that have been put through the business. Next, you can have items that are, unusual or non-reoccurring in terms of revenues or expenses. So common ones you see there can be, restructuring costs or one-time professional fees, or maybe one-time ERP implementation costs as an example. Next one is non-arm's length income or costs that may be above or below market rates. Typical example you can see here is, an owner paying themselves above market salary, and typically you make an adjustment for fair market value salaries in that case. Another one you see here can be a rent adjustment or for fair market value rent. Sometimes you see companies paying below market rent to a related company, and therefore you need to adjust earnings for what you would deem as fair market value rent. And then the last one there, just income or cost related to redundant assets. An easy example of this one is with investments on the balance sheet. This would be considered a redundant asset, and these investments may earn interest income or investment income, and typically you would adjust this out because it's not related to the core earnings of the business. And then in terms of LOIs, typically LOIs, like we said, are submitted based on a multiple of normalized EBITDA, and it's truly just in the vendor's interpretation of what normalized EBITDA may be. And a buyer may not or wouldn't have a chance to, prior to LOI, to really do extensive due diligence on those numbers. So that's why it's important to always do a buy-side due diligence and a quality of earnings report just to verify that vendors propose adjustments and also highlight any red flags that may be found in the earnings. And then on the flip side, it's also important to also consider a sell-side QOV, because this can inspire confidence to the buyer and can make diligence sometimes more smooth and minimize any surprises. So this slide just speaks about enterprise value, like we've touched on a bit, but really how to get to equity value. So we know typically in your LOI, you take your normalized EBITDA or your level of maintainable EBITDA and then apply a multiple to get to your EV or your purchase price. And then transactions, open market transactions are typically done, on a cash-free, debt-free basis. So in a valuation, you typically add back your cash or redundant assets, and then you deduct any interest-bearing debt or debt-like equivalents. And then in a transaction, you typically see a working capital adjustment be made. So what happens is, let's say the business's net working capital on close is higher than the target or the peg. there would be a dollar for dollar increase to the purchase price for that. And then on the flip side, if let's say the net working capital of the business that's delivered on close is below the target or the peg, then it would be a dollar for dollar downward purchase price adjustment to get to call it your adjusted purchase price or your equity value and evaluation. And then the figure on the right, the visual, just depicts how we get to enterprise value. And we know that enterprise value is your equity value plus your debt and debt-like equivalents. So now I just want to get into the internal company valuation factors. And the first grouping there is your financial performance and reporting. So in terms of revenue and EBITDA growth, companies that exhibit, strong historical or projected growth typically command higher multiples in the marketplace. And buyer confidence usually increases when they do see that consistent growth in a company. So if a company can also demonstrate that they've forecasted in the past and they've achieved this forecast, this not only gives buyers confidence in the company, but it also gives them confidence in management's competence as well. For profit margins, higher profit margins compared to competitors or industry standards typically lends to higher multiples as well. So this can mean, for example, the company may have, a lower cost structure, so they're able to realize higher margins, or maybe they've implemented some sort of automation or optimize some processes to cut costs. So if a company is looking to sell, obviously they should try to maximize margins. And the more granular management can get in terms of proving that out in terms of the reporting, for example, being able to provide margins by customers or product lines or SKUs, the better. In terms of cash flow stability, having those predictable and those reoccurring cash flows, for example, from subscriptions is highly valued in the marketplace. And it's also preferred by investors because it does provide more visibility in the future cash flow generating ability of the business. The last one there is just financial reporting, arguably probably the most important. Having clean financial reporting improves buyer confidence as well and reduces chances of, diligence red flags. Management has that ability to quickly provide clean, accurate, and organized financial information that gives buyer confidence in the business's operations and the financial. So some proactive things to do when advising your clients is, stop the cash accounting well before thinking about a sale, maybe 2 fiscal years worth of clean financials. Also stop putting personal expenses through the business in terms of ownership, putting personal expenses through. And then lastly, cleaning up your financials in terms of uncollectible receivables or any slow-moving inventory is also recommended. And then the second bucket there is related to customers and supplier relationships. So reoccurring revenue models such as SaaS models are more attractive. You'll see a lot of search funds in the marketplace, have this as one of their investment criteria because it does indicate stability and predictability. In terms of customer and supplier concentration, having a high dependence on just a few customers or suppliers substantially increases risks for a buyer. So if you have a diverse customer base of sticky customers as well, those types of companies typically will secure higher multiples. And just to give you an example, in the past, I met with a client that was looking to sell, and he let us know that 97% of their revenues was from one customer. So you can imagine the risk of not only buying, but running a business like that if that customer decides to go to someone else. And then lastly there, in terms of contractual revenue, long-term customer contracts provide, again, that visibility and stability in revenue. So it's important to, advise your clients to lock in those key customers and those key customer contracts before the sale because it also inspires confidence in the future of the business. So I'll pass it along to Dave, and he's going to continue with some further internal factors.
Thanks, Stefan. So continuing on that theme, the next internal factor that we want to talk on that really drives valuation is operational efficiency. So does the company have efficient operations that can be scaled for future growth? So the types of factors that you would look for here are, does the company have the technology infrastructure for scale? So if you're working with a business that has outdated tools and manual processes, then it's going to be difficult to scale and grow as a result of that. And eventually, or if you were to go to market, that business would command a lower multiple. Next, we have the capital expenditure requirements. So if the company needs to be adding substantial additional capex in order to grow, that would make the company a less attractive scale-up target and therefore less valuable. And also along the lines with the cost structure. So if the company is people heavy and similar to capex, in order to continue your growth, you're going to be needing to add a lot of incremental headcount. That inherently reduces the valuation because it's just not an efficient way to grow revenues. Increase in revenue won't have as substantial an increase in the bottom line if you have to constantly be adding headcount. And there's going to be a lot of growing pains as well, trying to constantly expand operations while training and retaining staff. And as a result, it just makes the business a less attractive valuation target and one that would, as a result, command a lower multiple if they were to go to sale. We work, just to put a bow on this point, we work with a lot of private equity firms that are buying private businesses. And generally, you see that they're willing to pay higher. They don't need a lot of capex to grow or headcount to grow. And that's just because it's easier for them to then apply their playbook to help sort of grow the business, to buy and build the business, and hopefully sell it later on for return. The next factor I want to touch on here is management quality. So this is just the quality of the people running the business on a day-to-day basis, as that may not necessarily be the owner, depending on the business you're working with. So the first item here would be leadership quality. So it's probably an easy one and probably an obvious one, but experienced, committed leaders are a big value driver for most buyers. They like to see that the people running the ship have been there and they know what they're doing. Along a similar vein, clear lines of succession are important, and that makes sure that one person or multiple people leaving doesn't destroy value. If someone were to leave, there's a plan in place, and there's staff who are reasonably well trained, so they could potentially replace him if someone were to leave. And the last one here would be owner involvement and effectively key person risk. So if the owner is required to work full time in the business, maybe they own all the customer relationships, kind of like what Stefan was just mentioning, and effectively they're the face of the business. That type of business typically commands a lower multiple because there's the risk that if the business owner were to leave post-transaction, it would take a lot of value with them. Or more accurately, what typically happens is if it's an owner-operated business, there's some sort of employment agreement that gets worked out where they'll stay on for 1, 2, maybe 3 or more years. But there's still that risk that after a sale, they've gotten a pretty substantial exit event, and they might be less motivated to work as hard on the business moving forward. So these types of businesses, owner-operated businesses, they're most attractive to buyers who are either interested in folding the company into a larger platform, basically a roll-up strategy, or for smaller buyers who are interested in running the business after close and aren't really turned off by the prospect of sort of buying a job. And the last item we wanted to touch on for internal company factors is just market position. So if within the market your brand is strong, you have a competitive advantage, or you're a leader within your niche or your geography, these can help increase the valuations of a business. Further, if you've got a differentiated product or service that's not easily replicated in the market, that can also increase the value of that business. Just puts moats around the business and helps to protect value and protect against some downside risk. So next, we want to turn our attention to some of the external company valuation factors that drive valuation multiples. And we've grouped these into 4 categories: macroeconomic conditions, geopolitical influences, industry trends, and capital market conditions. So first, I wanted to touch on the macroeconomic conditions. And these are the types of external factors that tend to get a lot of airtime in business news coverage. We're talking about factors such as interest rates, inflation, and GDP growth. First, with interest rates, higher interest rates increase the cost of borrowing, makes money more expensive, As a result, it tends to have a negative impact in multiples. When you're talking about GDP growth, this just affects overall confidence within the marketplace. More confident buyers are willing to spend more. And in terms of inflation, this can actually, depending on the type of business, it can actually have a negative or positive impact. There's certainly some businesses that actually outperform in times of high inflation if people are sort of turning to their goods as a way to cut money. Um, but and they're able to sort of pass on the increased costs to the customers while maintaining margin. But overall, these factors, these macroeconomic conditions, they tend to reflect the general economic cycle. And these are things that are sort of outside your control as a business owner or an advisor to a business owner. Next, want to turn our attention to geopolitical influences. So these would be factors such as trade or tariff policy, business regulations, and then overall geopolitical stability. So in talking to our clients, we found that overall with these types of geopolitical influences, the biggest challenge is instability. So most of your time, all of your competitors or all of the business's competitors are going through similar challenges. Where it becomes an issue is when buyers and sellers don't know what the operating environment is going to be like in the short term, let alone the medium or long term. And that just makes it difficult to find the confidence to execute on a transaction. So we have an example here. We worked with it was a car parts manufacturer. They imported products from Asia, and with the recent flurry of activity around tariffs, they just didn't know what on a week by week basis their landed cost of products would be. Made it very difficult for them to operate, very difficult for them to forecast out their earnings. And even though they were looking to sell or hoping to sell in the short to medium term, they decided not to go to market until tariffs stabilized. So next here we have industry trends. So these would be the larger trends focused on the industry in which a business operates. So things like overall sector growth, the competitive landscape, and then just general industry conditions. So with sector growth, businesses in growing industries tend to command higher multiples. It's generally the idea of a rising tide lifts all boats. If you're in a growing industry, it makes it easier for business to grow. Competitive landscape. So if a business is in an industry that is undergoing a high degree of consolidation, this could make it harder for smaller players. They could get squeezed out and as a result trade at discounted valuations. And lastly, for industry conditions, just the overall business conditions affecting an industry. So if a business is in an industry where companies are being acquired for low values, those valuation multiples will impact the valuation of that business. And lastly, here for external factors, capital market conditions. So things that matter here are access to capital. If financing is easy to acquire, it makes it easier for businesses to be bought. That will have a positive impact on valuations. Stock market performance. If your public company comparisons are doing really well in the market, that drives up the multiple for a private business. And then lastly, M&A activity. If there's a lot of activity in a sector, that tends to drive up the prices just by general supply and demand. More buyers leads to higher prices. The last thing I want to touch on here are just some trends in the M&A space, specifically in terms of financing and dry powder, as these are typically seen as leading indicators of M&A activity. And as you can see from the chart I'm presenting here, it's been up and to the right in terms of fundraising for private equity firms over the past decade plus. A slight retraction in 2024, but overall dry powder, just effectively cash available to deploy, remains high. This is generally concentrated within the largest firms and has been driven by below average exit activity amongst these firms. And this really leads us into our next polling question, which is what do you think the North American M&A market will look like for the rest of the year? So highly optimistic, optimistic, neutral, pessimistic, or highly pessimistic. So I'll give you a couple seconds to answer that one. Okay, so no one's too extreme. No one's highly optimistic. No one's highly pessimistic. About half of people are neutral, and we've got more pessimism than optimism. Very interesting to see. Obviously, just given the audience we have here with a lot of M&A professionals, people do expect it to be a down year. So Stefan, I'll pass it back to you.
Thanks. Yeah, so just to wrap up here, some key takeaways. I think it's important to optimize the business early. Start the planning of one of your clients that are looking to sell early, perhaps maybe 2 years in advance, and get the business ready and addressing any of those efficiencies while preparing it for sale. Also, it's important to understand value. I think pinpointing those key drivers, especially the internal factors that management can control, can really drive value. So it's obviously prudent to help your clients maximize those value drivers early. I think also preparing your clients for due diligence and kind of giving them the heads up of how intensive it is. A lot of these owner managed businesses, they have to continue running their business, but also answer a ton of diligence questions when the time comes. So just getting them in the right headspace and preparing them is obviously encouraged. And then also considering a sell side due diligence report, like we spoke about earlier. I think that just communicates transparency to the buyers and gives them some level of certainty, knowing that there is some level of assurance around the proposed adjustments by management. And like we said, it makes a diligence process, a tiny bit easier and more fluid. And then lastly, just engaging the right experts. I think it's important to advise your clients to advise or to engage right experts in all of these practices and disciplines, because having that good team around your client, it just increases the chances of a successful transaction or outcome for them. So that's all for our presentation. Appreciate everyone listening. And if you have any questions, feel free to type them in the Q&A prompt.
So we've got a couple from Catalina here. So the first one would be, are you aware of any standard procedures for a QV report? So yeah, at the firm, we do due diligence. We prepare quality of earnings reports. The standard items that would be resultant of a QV would be adjusting earnings adjusting to get to a normalized EBITDA. That's typically thought of as the number one output of a QV report. Also, items that are sort of deal-related adjustments. So calculating a normalized net working capital amount, often referred to as the working capital peg, would be a standard operating procedure. And then also summarizing all the net debt that'll have to get settled as part mentioned. Most deals in the space are cash-free, debt-free. So those would be the standard procedures for QV, although one of the things that differentiate a quality of earnings report from a sort of your standard accounting assurance engagement, a review or an audit, that it can be customized to the needs of the business a little bit more, because there isn't the same regulations and standards that define these issuance of these reports that can be customized. Obviously, we still have our professional designations that we have to adhere to the standards for, but how the report can look is a bit more flexible. Stefan, we got one for you that I think you can answer from Terry here. The last one, yeah, take it away.
So I think this one here we got, it says, what are the biggest 2 to 3 factors that can cause private valuations to fluctuate significantly? I'd say one of the biggest is obviously, market conditions that we spoke about. For example, the trucking industry. I was working on a deal and trucking's really slowed down and impacted values. Aside from issues in the financial reporting, which is another big internal factor, just the downturn in the trucking industry caused them to retrade us from the LOI, which was obviously not what you want to see, but it was expected. And like I said, having that clean financial reporting does make a difference. I had that same client prepared 2 different budgets. So the finance function prepared one budget as an example, and then operations prepared a different budget, and they didn't tie, and things like that can confuse a buyer in terms of the reporting and how to understand the business. So that caused them to also retrade us. So just an example, those are some of the factors that can affect business valuations. And then also in terms of systems and kind of the CapEx point Dave was talking about, if there's a lot of investment that needs to be put into the business, this is gonna drive the valuation down significantly when you're thinking about free cash flow rather than just normalized EBITDA. So I'd say those are the biggest probably factors. Dave, I don't know if you have anything to add from what you've seen, but
I was going to say the thing I'm seeing most often is the scalable systems.
yeah,
So the majority of private mid-market businesses are going to sell somewhere between 3 to 6 times EBITDA. And usually the 6 times or the ones closer to 6 times are the platform deals that have scalable systems in place. And then the ones that are trading closer to that 3 times would be these bolt-on acquisitions that they don't really have good systems. You're going to basically try to onboard them and fold them into the platform acquisition. So that's the number one driver I'd say. Stefan, how about this next one that we got in? How do you view recurring revenues? So annual maintenance or support contracts.
I
So it's
think
re reoccurring revenues such as annual maintenance and support contracts versus recurring revenues in terms of their impact on valuation. So I'm not quite sure actually what Terry's getting at there. I'm not sure if you would, Stefan.
I don't fully understand, but in terms of reoccurring revenues, buyers obviously would like to see that as opposed to a lot of project-based stuff. Having that visibility as to, this is what's going to be coming in. So, for example, from subscription type revenues. So having those visibilities on the revenues, I think that is a massive value driver. And those types of businesses, and a lot of those SaaS businesses are like that, and that's why they tend to trade in terms of high multiples. Those businesses, like we said, the tech type businesses do trade on that annual reoccurring revenue, so it is a massive driver for them. Um, yeah, Dave, I don't know if you have anything to add to that, but hope that answered that question a little bit. I didn't fully get the difference in the two, but
I think that's great. Um, and then we just have one last question here, which is just any particular sectors or company size that is getting more sort of kicking the tires activity this year. Maybe one that I can see we're seeing a lot of activity in. Um, a lot of activity in terms of kicking the tires, maybe less so in terms of closing deals. A lot in terms of healthcare. Specifically, we work across North America, Canada, and the US. And in the US, a couple of years ago, healthcare sort of vet clinics, dental clinics, they were going for really high multiples. And those multiples have come down. So the activity in terms of deals closing has really come off, but there's still lots of activity in terms of looking at deals, evaluating deals, and trying to come to sort of a more settled multiple from where valuations were just a couple of years ago.
just to add to that, I'd say trucking. I've had slow experiences in that sector. Probably the last like year and a half to 2 years, trucking's been pretty slow, but it just feels like deals in that space are taking a long time to close, and diligence is also getting extended significantly if they're doing cross-border type activities, especially with the tariffs that kicked in early March. So that's another industry that's not been doing so well, and it's tough to close deals for sure in that. And then I think we got another question here. What would be a EBITDA multiple and range for a tech and manufacturing company? It's tough to say because that obviously depends on size. My experience in those small to medium size businesses, those I've seen typically trade in that 3 to 6 times EBITDA range. I think is a very conservative range, and they typically do trade in that range if that helps.
And then generally tech companies trade higher because
Yeah.
well, tech companies generally, but specifically more like software companies because they're very scalable. Usually marginal revenue is like very high margin. So it commands a higher multiple.
Like obviously a
Yeah.
lot of it may be based on your recurring revenue as
Yeah.
opposed to a manufacturing company where it's cash flow based for the most part.
So with that, I think we've gone a little bit over the time we allotted. So thank everyone for sticking around to answer our questions. I hope everyone enjoyed the session today. And thanks to Eric and the whole M&A Club for having us.
Thank you, everyone.
Thank you, gentlemen. Thank you, everyone. Have a good day.
Yeah, thank you.